Sluggish growth in Brazil and Argentina is having a knock-on effect in Paraguay, a country pitted between the two economic giants. Here to share insight on how the banking sector is responding, Sebastian, Lahaie. Now let's talk about how you would characterize your country when it came out of the depths of the 2008 crisis.
Following the 2008 crisis, the response for Paraguay was to immediately lower interest rates. That reduction in interest rate laid the foundation for the future growth that we've experienced since then, both in the financial sector but as an economy overall.
So how do you think the banking sector found its equilibrium as it came out of this period?
To understand this, we need to look at the beginning over the last 10 years, since 2004, when the financial sector benefited from the first regulation that were set in place in Paraguay, resolution about provisioning levels, classification of bad loans, bad loan performance monitoring. The country started to experience massive growth into the financial sector that only slowed down slightly in 2008, 2009. Right after that, with the lower interest rates, the sector continued to grow massively and has fueled the growth of the country, which has averaged about 5% year on year for the last 10 years.
Given that it's had such a strong pace of growth, tell me, how has banking sector reform kept pace?
First, the country laid down the grounds for the rules for non-performing loan provisioning ratios. What kind of level do you need to have in the bank? How do you monitor the non-performance, 30 days, 60 days, 90 days? Over the last 10 years, the focus has now shifted to the solvency and the level of capital that each bank needs to have. We have currently a piece of legislation that's being discussed with the central bank and with Congress to reevaluate those levels of solvency and what level of capital do Paraguayan banks need to have. We have to bear in mind that there is no capital market activities in Paraguay. It's a very traditional banking system, commercial and retail. So having solvency ratios that are identical to the ones that we're trying to have in Europe or in the US is somehow very conservative and to a certain extent appropriate for Paraguay as well.
So as a country that's couched between Brazil and Argentina, who are heavily reliant on capital markets, tell me, how did the instability over there impact your country?
Paraguay has benefited from its own resources to fuel the growth of the banking system over the last 10 years. Most of the deposits in the banking system are from local Paraguayans and local investors. The banking system as a whole is not very dependent on external funding. About 15% of its funding comes from outside of Paraguay and mainly through multilateral agencies or development bank. So Paraguay is not a country, or its financial system, better said, is not a country dependent on external funding from capital markets per se. However, the interest in Paraguay has been such that we've seen a massive inflow of credit lines from development bank, multilateral, and that's that funding that has allowed banks in Paraguay to offer longer dated, longer maturity credits that have helped that growth. What we see now in Brazil and Argentina, which are two countries that were highly dependent on capital markets outside for its own funding, is that when that money dries up, if you don't have a solid capital base in the country itself, growth is impacted negatively.
Of course, ratings agency Standard & Poor had upgraded your countries to BB because they felt there was very stable overall outlook. Tell me, how has that impacted your ability to continue driving investment interest?
I mean, obviously, when a country grows at an average 5% per year for the last 10 years, it starts to draw, to bring attraction, and the light is currently shining on Paraguay as an investor destination. However, it still remains somehow an exotic destination for Latin America. It's not Peru, it's not Colombia, it's certainly not Chile yet. However, the potential for growth is very high. The increase in the rating of the country is giving the opportunity to some investors who have limitation in where they can invest their own funding, especially asset managers. It's giving them the opportunity to start discovering Paraguay as a potential destination for their funds. We're still not investment grade, but we are one notch below, and I'm hoping that within the next couple of years we'll get there. With that fame, or between brackets, sudden fame for sovereign debt, Paraguay has been able to issue government bonds for the very first time over the last 3 years. Through two separate issues, it placed about $1.5 billion of bonds. The temptation is always high to continue the issuance, and it's important to maintain a very tight fiscal policy, which Paraguay has been able to do. It's still an ongoing discussion, but I think it's one of the key strengths of the country, stable macroeconomic data.
Finally, can you tell me what is in store in terms of banking reform?
The average maturity for deposits in Paraguay has gone from about 6 to 7 months 12 years ago to about shy of 2 years now. We're still a long way to get longer deposits in the system. We're still very dependent on multilateral institutions, development banks to get longer term funding so that we can finance infrastructure that are very, very much needed for the development of the country. One piece of legislation that's extremely important to pass, and hopefully will before the end of the year, is private and public pension regulation, which will allow for the public institution to invest the pension savings inside the country. So if banks can issue long-term dated bonds, for example, public institution will be able to invest in those, and in return we can fund domestically long-term investments that are needed in the country.
Very interesting. Sebastian, thank you so much for joining me today.
Thank you very much for having me.